Picture money as a river. It never sits still. It simply changes banks. Most people try to fill their pockets with a little cup and end up soaked in bad debt. Credit cards, car notes, student loans that drain cash instead of creating it. Billionaires step into the same river, but bring an engine and a pipeline. They do not fear debt, they study it, price it, and turn it into an employee that works around the clock. Done wrong, debt drowns a household. Done right, it multiplies time, effort and capital so fast that decades of grind compress into a few focused years. Below are 6 equally powerful ways the ultra-rich harness borrowed money. Follow the logic, keep the numbers simple, and notice that every example circles back to one rule. Debt must put more cash in your pocket than it takes out. First, borrow the product, not the cash. Think of a pen wholesaler who wants to ship a container from Shenzhen to Chicago. He could wire $100,000 up front, but that freezes his capital. Instead, he builds rapport with the factory, shows past purchase orders, and receives the pens on 60-day terms. No money leaves his account until he has already resold the boxes to local retailers. The factory gains a loyal customer. The wholesaler gains inventory without touching his savings. The same dollars spin many times in a single quarter. Multiplied worldwide, this trade credit oils global commerce. Amazon vendors, supermarket chains, even car dealerships survive on it. For billionaires who own these companies, the principle is identical. If someone else will front the goods, your own money is freed to market, innovate, or purchase the next deal. Second, turn a fixer-upper into an ATM. Imagine buying a neglected duplex for $500,000 with a 20% down payment. You spend $50,000 on paint, plumbing, and a new roof. Now appraisers value the place at $700,000 because tenants line up to live there. You refinance at 80% of the new value and pull out $560,000. After clearing the original loan and the renovation bill, you pocket roughly $110,000 tax-free, keep ownership of the building, and let rent checks cover the new mortgage. Professional investors rinse and repeat this BRRR method: buy, rehab, rent, refinance, for apartment blocks, storage facilities, and mobile home parks. The secret is simple: force the property value up quickly, then let cheap long-term debt recycle your equity into the next project. Third, scale a proven business with other people's money. Suppose an online cosmetics brand already earns steady profits. A conventional owner would wait years for retained earnings to fund extra staff and marketing. A billionaire founder issues a low-interest corporate bond, hires 10 sales reps, doubles ad spend, and books bigger production runs that slash unit costs. Because revenue grows faster than the interest bill, cash flow explodes. Apple, Microsoft, and Nestlé all do this. They borrow even while sitting on mountains of cash because the after-tax cost of debt is lower than the return on new projects. On a smaller scale, a dentist might finance a second clinic, or a software studio may finance user acquisition. The pattern never changes. Borrow at 4%, earn at 12%, keep the spread, and repeat until competitors wonder how you leapt ahead. Fourth, use debt to bet on price moves, up or down. Leverage in the stock market magnifies gains and losses like a volume knob. Buying on margin lets an investor control $100,000 of shares with perhaps $40,000 of her own funds. A 10% rise doubles her money, while a 10% drop can wipe her out. Sophisticated funds take it further by short selling. They borrow shares they do not own, sell them immediately, and aim to repurchase later at a lower price. If they sell a stock at $100 and buy back at $70, the $30 difference, minus a small borrowing fee, is profit created from falling prices. The risk is uncapped if the stock rockets upward, so hedge funds balance shorts with longs, options, and detailed research. The lesson for budding investors is not to mimic complex trades, but to grasp the core idea. Debt amplifies every outcome, so only wager when the odds are overwhelmingly in your favour. Fifth, live on borrowed money and die owing nothing to taxes. The strategy, nicknamed buy, borrow, die, sounds morbid but is perfectly legal. Step 1. Accumulate appreciating assets. Trophy real estate, blue chip stocks, private companies. Step 2. Pledge a slice of that portfolio as collateral and draw a low-interest credit line for living expenses. Loans are not income, so no capital gains tax is due. Step 3. Hold the assets until death. When heirs inherit, US law resets the cost basis to current market value, wiping away decades of paper gains. They can sell the properties outright, clear the credit line, and still walk away wealthier than if you had sold assets during your lifetime and shared the proceeds with the Treasury. It is the ultimate use of time, inflation, and tax code to make debt a shield instead of a burden. Sixth, keep cash invested and let a cheap mortgage carry the roof. Mark Zuckerberg famously took a 1% mortgage on his Palo Alto home, even though he could have paid cash 10 times over. Why lock millions in bricks when Treasury bonds or an index fund earn more than the loan costs? At scale, every percentage point counts. An entrepreneur who finances a $2 million home at 3% frees up the $2 million principal to pour into her company, where returns might hit 15% per year. Even middle-class families can apply the logic cautiously. If a fixed-rate loan sits below expected investment returns and payments fit comfortably within income, deploying excess savings into diversified assets may build wealth faster than racing to kill the mortgage. The caveat, of course, is discipline. Invest the difference. Do not spend it on liabilities that depreciate. Debt, then, is neither angel nor demon. It is a lever, and the direction it tilts depends on knowledge, patience, and self-control. Billionaires measure cash flow before they sign, insure against surprises, and exit deals that no longer serve them. They understand that borrowing a depreciating currency to buy appreciating assets flips inflation from enemy to ally. Copy the mindset on a scale that matches your means. Start with credit lines you can repay from a single month's income. Study interest rates as closely as price tags, and treat every loan as a business partnership. When debt puts dollars into your pocket, you are the master. When it sucks dollars out, you are the servant. Choose the first role, and the same river that drowns the careless will power your own financial engine upstream. Let me know with a comment what you think, and if you agree with these 6 methods. And if you liked the video, like and subscribe for more content in the future. See you soon.